A lot of the big TradFis will only move meaningful assets on chain if they can figure out who the qualified custodian is and if they feel comfortable that the regulatory framework is clear enough so that internally the person who's saying, yes, please move significant funds over on chain, that they don't get into trouble. Clarity historically has been lacking. Now with the Genius Act passing, I think there's a lot of hope that that clarity is coming. I do think we need the market structure bill to pass because that will truly mark the moment where the TradFis have true clarity on how custody can work, how they can implement their custody solutions, who can actually hold these assets on chain, can that entity also hold crypto and the like. So once that bill passes, I think you'll see even more movement of TradFis on chain. But the writing right now is on the wall given the Genius Act. So the appetite of TradFis to start moving balances on chain and to prepare for that moment, I'd say is higher than anything I've ever seen. And I've been working with TradFi since 2016 on the topic. It's night and day difference.
Here we are with Ian Bode, Chief Strategy Officer at Ondo Finance. Ian, it's so great to have you on the Defiant Podcast. Welcome.
Thanks so much for having me. It's a pleasure to be here.
Yeah, so Ondo is one of the biggest RWA platforms, third largest in assets with 1.3 billion in tokens issued. RWA has been one of the biggest and fastest growing trends in crypto in the past few months. So very excited to chat. Just to get started for listeners who might not be totally aware of Ondo, can you explain what you guys are about?
Yeah, happy to. So Ondo Finance is a company that puts traditional financial assets on crypto rails. We also develop the infrastructure and services to give these assets utility on chain and to make the process of moving these assets on chain and move TradFis on chain a lot easier. We started doing that focusing on tokenized treasuries, but we will soon expand into stocks and ETFs. Ultimately, what we're really trying to achieve is putting these financial products on chain to enable access to a global audience that historically has struggled to get access to these financial products. In that sense, it's quite similar to what a stablecoin is doing to the US dollar and making it readily available to a global audience. We're doing the same thing, starting with US Treasuries and very soon expanding to US stocks and ETFs.
Awesome. Okay, so what problem from traditional finance are you solving with Ondo, and what's so good about putting assets on chain? So you mentioned one aspect was increasing accessibility. What else?
Yeah, so access obviously is the number one. It's not to be underestimated. Like people in the US in particular forget how easy they have it, how many people in the US have a brokerage account that they can access these stocks, treasuries, money market funds, and the like. Having access to a bank account is very easy. You're not worried every single day that your bank is going to falter. Whereas people outside the US in many jurisdictions actually have to worry about all these things. If they can move their assets, their savings and investments on chain, that is a significantly better mousetrap for them. In addition, once you move these assets on chain, you enable 24/7 mobility of the asset and allow you to kind of use them in DeFi in different ways. Take the example of a brokerage account. Even in the US, your assets are kind of locked in that account. You can't necessarily move them from one to the other. If your brokerage account doesn't offer 24/5 trading, tough luck. If your brokerage account doesn't offer you margin, or if you don't like the rate on your margin, good luck, moving it around. Once you tokenize an asset, it's very easy to move it around from wallet to wallet or from platform to platform, kind of what we're used to in a crypto setting, or if you want to send your ETH from a Coinbase wallet to a Kraken wallet or name your exchange, it's very easy to do so. That whole experience for US capital market products does not exist. But once you tokenize them, that becomes possible.
Okay, so speaking of tokens, I'd love to go into the more specifics of the assets that you have right now. OUSG and USDY. Can you go into how both of those work?
Yes, happy to. OUSG was the first asset that we launched back in 2023. It's a tokenized treasury fund. If you want to hold it, you have to onboard with us. You have to put your wallet address on an allow list, and then you can hold that asset. At the time, back in 2023, this was pretty revolutionary because for the first time, a tokenized treasury fund could be sent from one wallet to the other 24/7 as long as you were on that allow list. You could also put a smart contract. So for the very first time, people could use our assets in a DeFi smart contract for its use as collateral, which at the time was the first of its kind. Obviously, that asset does have limitations in the sense that you have to onboard with us in order to hold it. It's not very composable. So since then, we've also launched USDY. That one is a little bit more flexible in terms of how it moves in the secondary market and can be compared in that sense a lot more to a stablecoin. Both assets pay out their yield on a daily basis. They're fully backed with other treasuries and treasury funds. So the main purpose of actually holding these assets is if you have stable coins on chain, stable coins are great products, but they don't actually pay out yield. So if you want to earn yield, treasury yield, risk-free rate on your holdings, you onboard with us and you hold these assets in your wallet.
So is the main difference between OUSG and USDY the fact that you have to go through KYC and onboard with OUSG and not with USDY?
Yeah, so for both assets, if you want to mint and burn them from us, you have to onboard with us. OUSG is just a little different to the USDY because no matter, even in the secondary market, you can only send it to allow listed wallets. USDY is a little bit different in the sense that it moves slightly more like a stable coin. So in secondary markets, users can send it to other users, even if they are not onboarded with us. You can also very easily use that asset in DeFi, the broader DeFi ecosystem. We're live on 10 different chains integrated into, I believe, 100 different DeFi protocols, which is a lot easier with an asset like USDY as it is than OUSG.
So you can send it to other wallets, but can you buy it permissionlessly on a DEX or no?
There are people who have deployed DEX pools for liquidity of USDY. So people can, I believe, go on to a DEX to purchase this. The best way to think about this asset is kind of like, Circle and USDC. If you want to mint and burn USDC directly from Circle, you have to onboard with them. But after that, people can use it in the broader DeFi ecosystem, including setting up the DEX pool.
The main difference with stablecoins then is that you have that additional treasury yield.
That is correct. And also the investor protections of that asset are slightly different. When you hold USDY, you have what's called a security interest in the collateral. What that means is when something were to ever happen to Ondo Finance as the issuer, we have agreements with third parties that make sure that if you hold USDY, you have a claim on the underlying treasuries so that if anything ever happens to us, a third party can actually liquidate those treasuries into cash and repay all the token holders to make sure that they can recoup their balance.
Is that the same with OU?
Yes. So it's designed in a fully bankruptcy remote way. That level of protection you typically do not have when you hold a stablecoin. Some stablecoins, not all stablecoins are equal, to be clear. So some stablecoins have this, but the largest ones typically do not. So what you have there is an unsecured claim against the issuer. If something were to happen to the stablecoin issuer, you're not necessarily getting all of it.
Interesting. And how can you get that yield as a holder of USDY, for example?
Yeah, so we on the back end collect the yields that is being paid out, by these treasuries on a daily basis. We then manage the price of the assets. We set that up on a daily basis, and that is essentially how the yield gets paid out. So every single day you hold USDY, you'll see the price go up slightly. That is equivalent to the interest being paid out on a daily basis. Again, this is kind of better than what exists in TradFi often because their interest gets paid out on a monthly basis. We pay it out on a daily basis.
If in that sense, so it's convenient because you don't need to kind of lock a token in order to get yield. It just like kind of increases in price, but it's harder to use as an actual stable coin, right? Because like price is fluctuating. So is it meant to be more like a savings instrument than an actual stable coin?
Yeah, that's one way to look at it. It's similar to a savings instrument. You just have to get used to the price not being $1 per se, right? A lot of people get a little bit confused when they see that because they think, why is a stablecoin depegged? Well, it's not. It's just, we pay out interest that way. Technically, we also have a rebasing version. So you can hold a version of USDY. It's called RUSDY. That one stays at $1. And instead of the price going up, your balance goes up on a daily basis. The problem with that asset is that you can't really use it in DeFi very easily. DeFi smart contracts, their internal accounting doesn't really work with rebasing assets. That's why we, as a standard asset, have the value accumulating version. But technically, if a user really, really wants to have an asset that always stays at $1, they can hold rebasing USD.
Okay, so you've been doing this for a long time, and recently you've seen a lot more competition from, like the really big guys, BlackRock, Franklin Templeton, Apollo, just like really big names now participating in RWAs. BlackRock has its own US Treasury token with Bode. How do your products compete with theirs?
Yeah, I don't really think we compete really because it's so early. We're all just trying to build some of the foundational building blocks that make tokenized treasuries more helpful assets. I mean, BIDL is a great example of that, quite frankly. BIDL, in terms of its product structure, is more or less identical to OUSG. OUSG was just a year earlier, but clearly BlackRock looked at OUSG and its product structure and said, that's pretty good, let's copy that. But their innovation at the time when they launched was that they implemented, or Circle implemented, a facility that was pre-funded with USDC so that any BIDL holder could actually transfer BIDL into that facility and instantly get USDC in return. That was pretty meaningful because all of a sudden people could do 24/7 redemptions back into stablecoins. We then put a lot of our backing into the BIDL product to also have access to that facility and have since built on that concept to aggregate liquidity across multiple tokenized treasuries and have started offering that liquidity to other asset managers and even including the Franklin Templetons, the Wellington Managements, etc. of the world. So I'm not sure I would describe it truly as competing per se. I think we're all just building on top of one another to build some foundational building blocks to make tokenized treasuries more attractive as a category. And I believe you've seen that in the growth of that category because over the past 2 years, I think it has gone from $1 billion to $7 billion right now.
Yeah.
USDY is probably a little bit different in the way that it is structured and the fact that it moves more like a stable coin. I think that is a pretty uniquely differentiated product. But even on OUSG, I'd say we collaborate with the TradFis more than we compete with them.
Got it. Yeah, because even at 7 billion, it's seen really important growth, but it's just like a drop in the water versus much the $1 trillion US Treasury market. So there's still lots of room for all of you guys. Yeah. Okay, but speaking of growth, so you've had really fast growth. You started the year out with about 500 million in assets, and now you're at 1.3 billion. But that's kind of stayed at relatively the same level since around June. So what do you think explains kind of the slower growth recently? Do you think it has to do with like the bull market heating up? Maybe people are less interested in more passive instruments and want to speculate a bit more, or how are you seeing kind of growth drivers for you?
Yeah, I think that definitely, I mean, that's a factor to it, right? That people are, when a bull market hits, they're going to overall park slightly less money in tokenized treasuries overall. But I'm not sure I'd describe it truly as a slowdown in its current state. A lot of these tokenized treasury, particularly for OUSG and the like deals, they can be pretty large. And so some of the sales cycles, quite frankly, just take time. So the fact that over a period of 2 months, there's not a tremendous amount of growth in the category per se, I wouldn't say is a signal just yet of the category slowing down. I think it's more just the nature of how some of the sales cycles works. In addition, I mean, we just had the stablecoin bill pass in the US. There's a lot of emphasis right now to make tokenized treasury funds Genius compliant. Investors are waiting for it to be Genius compliant before they put more money into it. But there's a lot of conversations right now, even with the stablecoins themselves, to move some of their backing right now is off-chain into these on-chain treasury vehicles. So I actually expect the category to accelerate its growth, to be honest, not slow down.
Interesting. So what's missing for these funds to be Genius compliant?
There's certain components and stipulations in terms of what the average duration can be of the treasury assets that you hold. That quite frankly is the main thing. So, some of these tokenized treasury funds have to just change how exactly they allocate into treasury assets. Some of them have to change their mix a little bit in the types of assets that they also invest in. But by and large, these changes are fairly straightforward to make.
Related to your point that these deals have a longer life cycle, I was curious about who the buyers of these tokens are. Where does demand come from?
Yeah, I'd say it's pretty diverse. It's a lot of on-chain native capital that historically has held a lot of its assets in stablecoins, but now realize that, why forego the yield if you can just park them in these tokenized treasury assets. So there's some hedge funds, there's some VC funds, there's some crypto native foundations that are parking their assets in these tokenized treasuries more broadly. And increasingly, I would say you're starting to get even some TradFi players, they're starting to put some of their balance sheet in these tokenized treasury vehicles. They then appreciate the flexibility of, again, putting that into stable coins, but some of the TradFis are actively looking at that. And then increasingly, some of the stablecoin issuers are exploring putting their reserves into these tokenized treasury products.
And what's the plan to further integrate with DeFi? Like how are you looking at these partnerships?
Yeah, so it depends on the product you're looking at. OUSG, because of its permission nature, is slightly more challenging to integrate into DeFi, and that requires typically bilateral agreements. USDY is significantly easier to integrate into DeFi protocols, and over time, we've just added USDY to more and more DeFi protocols, or DeFi protocols have added it themselves, given the permissionless nature of it. So right now, I believe we're integrated into 100 different DeFi protocols on 10 different chains. People like the use of USDY as a form of yield-bearing collateral, particularly in some of the purse markets margin protocols, and we accept that adoption to further continue.
Okay, so you said demand is coming from a kind of on-chain treasuries, foundations, also hedge funds and VCs, but you're starting to see more kind of traditional finance also become interested in these assets. Going forward, how do you see that evolving? Like what will drive more of traditional finance onto, have more of their balance sheets in
Yeah, historically, the big lacking factor was just regulatory clarity, right? A lot of the big TradFis will only move meaningful assets on chain if they can figure out who the qualified custodian is and if they feel comfortable that the regulatory framework is clear enough so that internally, the person who's saying, yes, please move significant funds over on chain, that they don't get into trouble. Clarity historically has been lacking. Now, with the Genius Act passing, I think there is a lot of hope that clarity is coming. I do think we need the market structure bill to pass because that will truly mark the moment where the TradFis have true clarity on how custody can work, how they can implement their custody solutions, who can actually hold these assets on chain, can that entity also hold crypto and the like. So once that bill passes, I think you'll see even more movement of TradFis on chain. But the writing right now is on the wall given the Genius Act. So the appetite of TradFis to start moving balances on chain and to prepare for that moment, I'd say is higher than anything I've ever seen. And I've been working with TradFi since 2016 on the topic. It's night and day difference.
Really? How are you seeing that?
Everyone wants to get involved. Quite frankly, everyone's worried now about, missing the moment. Because these days, I think people understand what a stablecoin is increasingly. Not everyone's there, but the whole concept of moving assets on crypto rails and making it available to a global audience, that's kind of a very easy narrative to understand. And once you understand that for a stablecoin, you can then very easily draw the parallel to broader US capital market products. So if you look at the growth of a stablecoin and even the growth of tokenized treasuries to date, it's quite easy to see how other asset classes can experience a similar hockey stick. That for TradFi is a move that they cannot miss. And they've always been comfortable putting the brakes on as long as they could be a fast follower. But the moment to fast follow is now. So there's only so many also crypto native companies that these TradFis can work with, right? A lot of them do not have the capabilities in-house to truly start moving on chain. There's not that many credible crypto native companies that can help them make that move. And so there is a little bit of, I wouldn't call it partnership FOMO going on, but these TradFis are smart enough to know that the time to move is now. They cannot miss the move, and crypto native companies only have so much bandwidth to support them. So if they want to start making the move, they need to act now.
And you're seeing that on kind of the issuer side and also asset managers. So like, funds who want to issue their own funds on chain and offer that to their clients, but also just like asset managers who want to get like just better yield or more flexibility on their tokens? Like, are you seeing from both sides?
Yeah, I think right now there's definitely a move among the asset managers. Asset managers were kind of the first ones to make the move in the first place. If you look at kind of what Franklin Templeton did, Wisdom Tree, BlackRock, they were first to start issuing these tokenized funds. And there's many more large asset managers that are now working on their tokenized funds to move it over. We as a company will soon put, tokenized stocks and ETFs on chain. It will be to non-US investors in the primary market. But, a lot of the asset managers are aware of that and then want to work with a company like Ondo to make sure that their products in its traditional form can make it onto crypto rails and be distributed to that global audience. Like the concept of crypto rails as a distribution channel, a lot of these asset managers, I believe about, 2 years ago, already figured that out. What you're now really seeing are the banks that are starting to catch on, and the bigger, call it capital markets institutions like the exchanges and the CSDs and the like, and thinking, oh boy, we need to start making our moves as well, because the asset managers have started moving. Now the banks and the other capital markets institutions, infrastructure institutions need to start.
Wow, it'll be an interesting next kind of few months, especially, hopefully if we see kind of those regulatory milestones with the market structure bill. I'd love to talk more about your plans to tokenize equity. So we've definitely seen a lot of movement on this front this year, with Robinhood announcing their tokenized equities for the European market. There's X stocks on Solana that Kraken and Bybit are offering. There was also tokenized, like Galaxy, their tokenized equity via Securitized. So lots of movement there. What are your plans, and how does it differentiate from kind of all these just emerging projects?
Yeah, it's very funny to us now. I mean, we love it that there's so much emphasis on tokenized stocks. We wrote our first blog post about tokenizing stocks last year in February. And at the time, no one cared, right? People were still working on tokenizing real estate and private credit and God knows what else. But we've always thought that tokenizing public equities is the logical next step, because you want to make sure that these assets have very clear demand globally on chain and pricing transparency. And with US stocks and ETFs, that's what you have. So we absolutely welcome Robinhood making their announcements on tokenizing equities and the like. Our model, there's different models out there, right? Some people tokenize stocks, and when you look at the fine print, they're not backed one for one. So what you're really then buying is a derivative product. We don't really go for that model. We believe it is much better to always back something one for one, and even on top of that, have a collateral buffer so that a user can always rest assured that the token they're holding is fully backed and then some. So our assets are always one for one backed in the way that we issue them. The other difficulty when you tokenize equities is, how do you make sure that the price of the asset on chain reflects the price of the asset off chain, and you can offer both assets with a similar level of liquidity? When you've looked at some of the other models that have been launched on chain, the prices don't really stay stable. They depeg quite often from the underlying, in large part because these models rely on on-chain inventory and on-chain liquidity, often in DEX pools that people can trade in and out of, because there's not an easy way to instantly get the asset from the issuer just in time at the same levels of liquidity and depth of market that exists in traffic. Our model is very different in the sense that we have found a way to more or less put these assets on chain just in time, so that anyone who's looking to purchase can go to our collection, our ecosystem, and acquire these assets at the same prices and the same level of liquidity as is available on TradFi. So when people buy these Ondo tokenized stocks and ETFs, they can rest assured that the price they get is more or less the same price as they would be able to get in a brokerage account. And that fundamentally is incredibly important for the trust in the asset and making sure that what you buy gives you the right economic exposure to the underlying asset at the right price.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
In your model, is the actual owner of the equity still Ondo, or is it the token holder? Does the token holder have rights to the company? Like, can it participate in governance? Like, can it redeem their token for the actual stock eventually?
Yes, great question, because there's been a debate on that and which model is kind of better. So our tokens are issued as wrappers, meaning that what you hold on chain is the economic exposure to the underlying. It is not the same as holding the exact stock. That model is very similar to a stable coin, right? When you hold a stable coin, you don't hold the same, bank dollar as it is sitting in a bank account. You essentially have economic exposure to that dollar. So you want to make sure that that stable coin you hold, you always have an ability to redeem it for $1. And similarly, our tokens, as you hold them, you have the ability to redeem them for the dollar value of the stock that it represents.
Okay, for the dollar value, but not for the actual stock.
No, not for the underlying stock. That model, if you want to have the actual underlying stock on chain, that requires native issuance. So you have the likes of a super state that is going after that, as you previously mentioned. The problem with that model right now is that it requires the actual company that the stock represents to agree and issue the stock on chain. So certain crypto native companies have done that, like Galaxy, and there's quite a few more coming. But that's not a scalable way to put broader US capital markets on chain. I mean, think about the stablecoin. A native issuance would have been the same as a bank agreeing to put their native deposits on chain and then make it freely available to a global audience. That clearly didn't happen. You had companies like Tether and Circle that agreed to put $1 in a bank account and have a token on chain that represented that backing, and always make sure that you could transfer it into the dollar value of the token. Our model is very similar in that it is much more scalable. It allows us to put the broader set of 1,000+ US equities and ETFs on chain for a global audience, but that requires the wrapper format, which is in and of itself no issue whatsoever, as long as what you hold is sufficiently backed, has a collateral buffer, and actually gives you a security interest in the underlying, which is what our model provides.
And that includes, like, say, if the company pays out dividends, would that be included? Would that be reflected in the price?
Yes. So when a company pays out dividends, we automatically reinvest the underlying, and the price of the token on chain as a result will move up because it gives you more rights to more underlying stocks that are backing it. It's quite similar to what we previously discussed with USDY. When treasury assets pay out interest to us, we invest it into more treasuries, so the price of the asset goes up. You always have economic exposure to the treasuries and the yield that it pays. Similar for our tokenized stocks and ETFs, we will reinvest the dividends after withholding the appropriate withholding taxes. And as a result, the token you hold is going to go up in value, so you always have the full economic exposure to the underlying.
Oh, I see. So this is, when is this expected to go live?
Yes, you can expect more from us in the next couple of weeks. Publicly, we have stated by the end of the summer, which is coming up soon.
Nice. Okay, and you said 100+ stocks will be available?
That's right. At launch, we will have over 100 stocks and ETFs available, and we will soon rapidly expand that. By the end of the year, we aim to be at 1,000 or so.
And where will people be able to trade them?
We will launch on mainnet Ethereum for starters. We will expand that to Solana and the BNB chain pretty soon after that. We are working with a lot of the centralized exchanges as well that are interested in listing our assets. So people with an exchange account will be able to buy it. And, as mentioned previously, these assets are structured in the secondary market as permissionless bearer instruments. So we expect people to use them in DeFi and find out ways to have them integrated into the DeFi ecosystem, which may open up more access.
So I think tokenized stocks kind of make sense in theory, but we haven't really seen that market take off very much. Like it's been tried before. I agree, like recently the big change has been more regulatory clarity, but like Synthetics was probably the first one to try this. I think like back in 2019 it had like S Apple or S whatever stock, and that market was pretty small. Then obviously there was a Mirror in the Terra ecosystem, and that got shut down for regulatory reasons. And then more recently the X stocks I don't know. I think they've been off to a kind of a slow start. Like I saw a report that said that the first like 2 months had like around 500 million of liquidity, and that's like a day's worth of trading in Solana. you know?
I think the total TVL of these assets is even lower, right? I
Yeah.
think it's less than $50 million.
Mm-hmm.
So I would agree that they are off to a slow start. I will think the critical thing to highlight, though, is that in all of the models that have previously been tried, they either did not have the right legal structure and backing, right? Like when you were holding an asset that was issued on synthetics or the mirror protocol, it was just purely synthetic exposure that was backed by nothing. A lot of people do not feel comfortable with that, and rightfully so. Recently, with the other models, at least in some, it is backed one for one. But there, the issue so far has been these prices do not stay pegged to the underlying stock. So you as an investor cannot really be confident that what you're buying truly is the underlying price. It's like buying a stable coin at 1.05 or 1.10 dollars. No one's going to buy that stable coin if they can't rest assured that a dollar is a dollar and they're not overpaying. So I think in part, yes, the adoption has been slow. We would argue that that is because none of the existing product structures truly has met the need for both the right legal structure, the right investor protections, and the right liquidity and pricing model on chain. But we're pretty confident in our model that it will be the first that achieves all of those things.
And do you think demand comes from just like retail crypto holders who just, maybe they're not US based and they want exposure to US equities, for example?
Yes. We believe the first cohort of users is going to be the same people who have figured out that a stablecoin is an easy way to get access to the US dollar. At some point, will want to have access to US capital markets. We also expect quite a few crypto exchanges to start listing these stocks. It's a lot easier for a crypto exchange to list tokenized stocks than it is for them to list it via a normal clearing broker and have to work with fiat rails and banking. It's significantly easier if you can do all of that with tokenized stocks, do the settlement in stable coins. It's a much easier integration for them. So we do expect quite a few crypto exchanges to list these tokenized stocks, and for the demand as a result to be that retail audience that now has access to US capital markets that they previously did not. But it's very possible, just to caveat all of that, I guess, a little bit, when you look at stable coins and tokenized treasuries, like the adoption, it happens, it accelerates at a certain point, but it's still a slow process. So if you were to ask me, how big do I expect tokenized stocks to be, this year, I don't think we'll be at the billions in TVL. I think we'll be probably more in the hundreds of millions. Next year, we'll probably be in the billions. And after that, hopefully we see accelerated growth. But typically these things do take a little bit of time, because there's just a lot of user education that's required, right? People want to better understand, how does this work? What am I actually holding? It takes time to have DeFi integrations for these things, to give them utility, and to really make the on-chain assets better than what exists in a normal brokerage account. That all just takes a little bit of time. And with that increased utility will come better adoption.
Yeah, that makes sense. Shifting gears a little bit, you announced back in, I think, February, the Ondo Layer 1. Just curious, what's the status of that? Like, is it being used and for what? Like, what's happening there?
Yeah, very much so. So the Ondo Chain testnet went live earlier this year. The production pilots are already in flight. We had the first transaction on that testnet was in a collaboration with JP Morgan. We had a tokenized treasury settled against cash that was available on JP Morgan Connexus platform. It was kind of a first of its kind with a bridge between private banking rails that operate 24/7 as well as a public blockchain, albeit in testnet. But that was very helpful for us to just do an initial proof of concept with JP Morgan, and it amplifies what ultimately the vision is for the Ondo chain. Say number one, it is the integrations into TradFi that are needed in order to move towards 24/7 capital markets. And in parallel, it's building out a DeFi ecosystem that can work with tokenized stocks and ETFs and really put brokerage on chain in the way that users are used to. The current DeFi ecosystem is very good, very robust. I'm a big user of DeFi myself, but I don't think it's built to actually support 1,000 different stocks and ETFs at scale 24/7. So we're going to have to rethink how certain DeFi protocols work, and that's the stuff that we're trying to incubate on the Ondo chain. So it's very actively being worked on. More on that later and more to come.
So is it still in testnet?
It is still in testnet.
Okay, and so right now the status is you are developing DeFi protocols on top of this layer 1 testnet.
We are working with a lot of the TradFis to have the right hooks into the TradFi networks so that any transaction involving securities on chain can also have the right, settlement leg in TradFi or the right transfer agent integrations into TradFi. So we're actively working on building those integrations with our TradFi partners, as well as developing a select DeFi ecosystem that is going to give utility to these tokenized stocks and ETFs.
Can you give me an example of how you envision like a use case that you see working well in your layer 1?
Yeah, so one of the key things that people expect to do with tokenized stocks and ETFs really is margin, right? People want to be able to pledge their tokenized stock and ETF as collateral and take out a loan against that, whether they want to buy a house or do something else with it, TBD. A lot of people also actually want to take bigger margin, maybe even take leverage on these assets. In a normal brokerage environment, you can hold 1,000 different assets. Your brokerage account will just tell you, here's how much margin you have available. Here's the rate you get. Ta-da. In DeFi, though, doing something like that for 1,000 different stocks and ETFs and doing that at a cost of capital that is competitive with TradFi is very, very challenging to do. Most DeFi protocols are not built to support 1,000 assets. And if you want to have these liquidity pools in DeFi for margin, all pre-funded in USDC that is not paying out any yield to the holder, that's going to be very, very costly. So it's most likely going to be pretty expensive and difficult to compete with TradFi rates if that is the DeFi model that you have to rely on. I think the way we're thinking about DeFi is going to be slightly different or augmented in the sense that what it's really going to be about is ensuring that whatever a user wants to do, if that's margin or something else, they can really tap into the existing DeFi liquidity that exists on chain, but also the TradFi systems that have already built to facilitate some of these use cases like margin. The way margin works in TradFi is very established. There's a bunch of people who are willing to do, this is essentially prime brokerage. But moving prime brokerage on chain requires the right integrations into these TradFi venues, making sure that they can operate 24/7 as needed, because on chain DeFi obviously you're going to need 24. And once we have the right integrations, I think it's going to be possible to have the best of the on-chain DeFi world, but also really have the TradFi rails and existing liquidity in TradFi be available for those DeFi use cases.
Interesting. Do you expect to compete with Hyperliquid, which does something similar with perpetuals and offers this kind of, margin?
It's a great question because people in crypto right now love perps because it is a capital efficient way to get leverage on assets. In TradFi, people have found different ways via prime brokerage. You can get margin, you can get leverage, I believe up to 20x on stocks, but in a very different way. And so I think over time, it's going to be very interesting to see what actually provides the best type of exposure, what provides you with the best cost of capital to get leverage on some of these assets. And that may very well end up being perpetuals. It may very well end up being similar to a prime brokerage model. I don't know, but I think it's going to be very interesting to see how that plays out and how ultimately maybe all of these rates start to diverge so that the rate available, the cost of capital on chain is actually the same cost of capital as in TradFi. But we're pretty far away from that, quite frankly.
Interesting. Okay, so this will be like an alternative way to get leverage on tokens, alternative to perpetuals, I mean.
That's one way to describe it, yes.
Interesting. When is there a timeline for mainnet? When mainnet?
When mainnet, right? I'm quite hesitant to put a timeline on that because in some of these things, it requires the right TradFi integrations, and as much as Ondo can move very quickly, some of our TradFi partners cannot. So I'm typically very hesitant to put a timeline on that, but rest assured it is being worked on very hard.
Interesting. Okay, well, I can't wait to see more news on that front. Okay, now talking about real world assets more broadly. So we've talked about money market funds, equities. What are kind of the next categories that you think make sense to come on chain?
I mean, we're very early innings of tokenization of equities, right? Like fundamentally at Ondo, we believe that tokenization makes sense to do two things. Number one is you want to enable access to a global audience by putting the asset on crypto rails. And number two is you want to enable these assets as some form of collateral on chain. And collateral on chain can be used for a wide variety of purposes. You can use it for margin, you can use it for staking, you could use it for a wide variety of ways. But those are the big two reasons why you would put an asset on chain in the first place. When you look at both of those, having the right pricing transparency is actually very important for both. People are not going to buy an asset that they have difficulty understanding what the value of that thing is. And if the value of the thing is not entirely clear, no serious DeFi protocol is going to allow you to use it as actual collateral, or the haircut they would put on that is so absurdly high that it limits the use of it quite significantly. As a result, you end up with assets, traditional financial assets, that have a lot of liquidity in traditional markets, and as a result, very good price discovery. That ends up being, obviously cash, a dollar is a dollar, hence stablecoins took off. Tokenized treasuries, hence tokenized treasuries were the next iteration of that. Equities, stocks, ETFs, very liquid traditional markets. And then there's probably a few more like commodities, right? Some of the fixed income products maybe, but there's still a lot of talk about tokenizing real estate, even private credit, broader private assets. I think there you start to run into difficulty on how much are these things actually worth and how do you create price transparency and price discovery in these assets. So anything that's liquid in traditional markets that has a lot of price discovery, we believe that makes sense to move on chain. Anything else, I think, will be slower in adoption and TBD and whether it.
Interesting. Okay, so do you think that eventually all assets will come on chain, or do you think that like what you just said? I mean, we're talking about like in a really long timeline, decades.
In a really long timeline, there are ways to solve the price discovery issue, even for illiquid assets as technology evolves, right? There are ways to almost instantly price real estate, for example, as long as you have the right information at your fingertips. So over time, will most assets move on chain? Probably yes, because the infrastructure is just significantly better than what exists right now. But the sequencing of the assets, I think you'll have obviously stable coins, treasuries, and then, public equities, commodities, and the like, which is where we have focused before the other assets move over. I will say, though, the market size of those liquid assets is big enough to, I think, satisfy everyone's demand for quite some time. Mm-hmm. If you look at the total market size of publicly listed securities globally, you're at 130, 140 trillion dollars. So I do think that's enough to tackle first and foremost.
Yeah, and that's a good segue. I wanted to ask you, how big do you envision the RWA market will be next 5 years? Right now it's at 26 billion.
Yeah, I think, I do expect to see pretty exponential growth in RWAs overall, particularly as the TradFis and TradFi infrastructure moves on chain. That is starting to happen. It's not 100% there. Like the big difficulty when you tokenize an RWA is how do you take the liquidity that exists in off-chain venues and easily port that over to an on-chain venue so that you don't have to duplicate that liquidity, because that's very costly. You also want to make sure that these TradFi systems can operate 24/7, because on-chain operates 24/7. If they don't both operate 24/7, you have some sort of liquidity mismatch. As an issuer, that's the thing that keeps us up at night. So we're almost there, I think, in starting to definitely build the systems and bridge that liquidity mismatch. That probably gets solved in the next 2 years. Once that's truly solved, I think all bets are off, and you're going to see things move on chain in the tunes of hundreds of billions, if not $1 trillion. So, where is it going to be in 5 years? Any prediction I make is inherently going to be wrong, but I think it may actually surprise a lot of people on the upside.
Interesting. Okay, now to wrap up, we've talked about the interesting milestones coming up for Ondo, Equities, your layer one. Anything we missed that's exciting coming up?
Oh, I can guarantee you both of those things keep us very busy already.
100%. Just making sure I didn't miss anything big.
Well, I'd say we're very, very focused on bringing Equities on chain, multiple chains. I think once our platform is live, as mentioned before, we'll start working very actively on making sure these assets have the right utility on chain, so that essentially, ultimately, what you are going to be able to do is do prime brokerage on chain across a wide variety of asset classes. The other thing I think is going to be very interesting to see, we've talked a lot about Ondo's role in this ecosystem as the issuer, but once you have these tokenized stocks on chain, I'm very curious to see the level of innovation that's going to happen on chain with these individual tokenized stocks, because that hasn't really ever been the case before, where you had a tech stack that allowed for permissionless innovation and people to build DeFi protocols and systems where the underlying stocks can move 24/7 globally, right? So how do you think about even creating a concept similar to an ETF? That all of a sudden becomes trivially easy to do for anyone on chain. How do you think about creating a robo-advisor or these custom strategies that people would want to build? That becomes pretty trivially easy to do. Even like, recently I personally wanted to buy a defense ETF. I thought defense stocks were going to go up, but I looked at the defense ETFs out there and none of them actually had Palantir in any meaningful shape or form. So once these stocks live on chain, it's going to be pretty trivially easy for me to actually request someone, a smart contract, a robo-advisor, whatever it is, to say, hey, I'd like this type of exposure, but please add in 20% Palantir and then, rebalance quarterly. So that level of innovation and what people really are going to build on these individual tokenized stocks, I think is going to be very interesting to see.
Yeah, that'll be really cool. Okay, and then finally, just looking at a more long-term horizon, if Ondo succeed, what does that look like?
Yeah, I think, success to us, we're very mission driven in the sense that we truly believe that what we are building gives global access to US capital markets to a global audience. I think that is inspired by what stablecoins have achieved so far and what they continue to do. So I think success for Ondo ultimately is really creating that open access ecosystem, building out the infrastructure for global finance to start moving on chain and to help the TradFi institutions as well as every relevant asset class to move on chain, so that ultimately in 10 years when people will say Wall Street, they don't really mean a place in New York, but they mean a set of open global rails that Ondo helped build.
A very different kind of street, more like a chain.
Yeah, that's right.
All right, Ian, thank you so much for joining me. This has been fascinating. Yeah, I can't wait to see what you guys are building with Equities, your layer one.
Thanks, Camilla, for having me. It's been a pleasure.